Welcome to Hot Sectors with me, Punita Kumar Sinha. Here we take a 360-degree view of the sectors that have seen policy initiatives and analyze the investment opportunities in those sectors. Today we look at India's power sector, which is vital to India's growth and development. Unfortunately, the sector is plagued with problems of insufficient fuel linkages, SEB losses and execution delays. This has affected the profitability of the power companies and their stock market performance. There have been recent positive announcements such as debt restructuring package for DISCOMs and a continuation of tariff hikes. Today we will analyze whether this will affect the investment outlook for the power sector or not. I'm joined by Prabal Banerjee of Adani Power, Karthikeyan Ranganathan of Barings Private Equity and Anup Bagchi of ICICI Securities to discuss just that. But first, let's just take a quick look of the state of the Indian power sector today. Nikhil Shivadas has this report.
It's the world's second fastest growing economy, but India is now struggling to achieve 5 to 5.5% GDP growth. Any attempt to regain former glories will first have to start with fixing the troubled Indian power sector. Here, tight supplies of coal and natural gas has severely hampered production in existing power plants, while the reluctance of lenders to lend more money is preventing the construction of new ones.
The most immediate problems we need to tackle are the implementation problems affecting large projects, including particularly power projects which are stuck because of delays in getting clearances and fuel supply agreements. We have taken a number of steps to deal with this problem, including the establishment of a new Cabinet Committee on Investment under my chairmanship.
From amendments to existing fuel supply agreements to price pooling of coal, various measures are being discussed to resolve the problem, but a final decision is still being awaited. Experts believe that investments worth an estimated 1,75,000 crore rupees are in danger of turning into non-performing assets unless the situation is resolved, a scenario that could severely affect economic growth in the country.
To discuss the power sector, I have with me Prabal Banerjee of Adani Power. Thank you very much for joining us today, Prabal. Let me start by asking you, what is the viability and economics of investing in the power sector today, given the PPAs and fuel linkages?
There are issues like coal cost, particularly when you actually import it from outside the country and suddenly people actually impose certain regulations which are beyond the control of the producers or developers in our country. That's number one. Number two is that very clearly that the supply that is supposed to be from Coal India Limited as per the FSA has to be proper and as per the ACQ. If that is not there, then also there is an issue that can come up, because if we do not have the coal, we cannot actually generate power. In addition to that, you have other risks like foreign exchange risks when you are forced to import from other countries. So all of them taken together, if the issues are not addressed as of today, obviously people may think that there is a viability issue if somebody is actually generating power, particularly the thermal power stations in our country.
Let's talk about you. Why did you bid so low for these PPAs? Why didn't you anticipate some of these issues coming up?
You see, those are the issues which was never thought of 5, 6, 10 years ago. And it's not only us, nobody thought of.
You're saying that the PPAs should be revised. But in that case, shouldn't they just be rebid?
No, I am not saying that PPA should be revised. Because of imposition of export taxes in various coal exporting countries, our cost has been increased, which was not perceived at any point of time. And there is short supply of coal by Coal India Limited. So if the force majeure imposes in such a condition that our cost is gone up, that should be made a pass-through. When the cost comes down for various other reasons, then it will be, the consumers will be benefited in the same way.
If this happens, then the customers will be facing a much higher price of power. right?
Yes, sir. Can I put you in perspective, Punita? I think you need to recognize the fact that as of today, the latest bid that came in for one of the states bidding, already the minimum bid has been in the region of 4.75 upwards, and the highest price has been more than 7 rupees. If you look at various other bids that is going on in the country, it's 5, 6, 7 rupees. If you look at the merchant pricing, except a dip that has happened because of the severe winter in the last couple of months, the merchant prices are in the level of 4.5, 5 rupees. And I can assure you that there is every indication and writing on the wall that power prices will move northbound even if you do not actually change anything, because the cost structure as a whole has moved up.
Right, but coal has been an issue across many countries for a long time. Coal prices haven't been stable. So, I mean, I'm just wondering why you wouldn't have factored in and asked for a fuel pass-through from the very beginning.
In fact, yes and no at the same time, because if you look at this, we can only ask for it only when it becomes effective, which is September 2011. So when it became effective for the export tax from Indonesia, from where we get our coal, we actually went ahead and asked for it. Unless the event actually happens, we should not ask for unnecessary increase in coal. In fact, if you look at our financial numbers, before the implementation of the Indonesian law, we were absolutely okay. We were making profit, and there is no reason why we should actually ask for price increase.
So you think, would you now recommend anybody to invest in coal mines overseas? I mean, given your Indonesian experience?
While Coal India is actually planning to go from 426 million metric ton to 615 million ton by 2017, but still I think the demand for coal in this country will be very high for quite a long time to come. And there is still a financial case for investing in coal mines abroad.
So how do you see the industry deal with the challenges of getting fuel linkages?
The right steps are being taken. So that's a very positive thing. I think important thing is that the linkage allocation policy has to consider that which are the plants which are coming up fastest and which will be ready to generate power. Because it cannot be that the linkage allocation policy and the coal delivery by Coal India policy is such that because of certain other reasons, where the plant is ready for generation, they are not being given linkage or power, and there are linkages and powers and coal blocks are allocated where the plant is yet to come up. The differentiation has to be made because the country needs power.
So you're saying basically favor the people who are executing well?
Absolutely, because what is the ultimate purpose? Getting the power? So if that is the purpose, the only way to do that is to give the coal to somebody who has the plants ready.
So what are you doing about your own fuel linkages? Like how are you planning to get the coal, and what about the shortage? Like there's a gap still, right? What are you planning to do for that?
Some part of it has to be imported, but we must say that we are actually requesting that even the gap shortage that is coming over there should actually be best handled by doing a pooling of pricing of coal.
But there has been some announcement on the pooling of coal prices.
Yes, I think it is being seriously considered.
So let's just turn to the DISCOMs now and the state electricity boards restructuring, and of course the recent tariff increases that have been announced in a few of them. What's your view on that?
This will actually save the DISCOMs from going into some kind of bankruptcy, if we may call it. Question remains, would you look at only that segment alone? What happens to the IPPs who are actually selling to the DISCOMs? In the same way, you are trying to save the DISCOMs from near bankruptcy by doing all that we can do. I think our approach to the appropriate authority for incorporating the force majeure clauses and considering a cost pass-through, fuel cost pass-through, is on the same basis that the developers also need to be financially stable and viable to supply to the DISCOMs on a sustainable basis.
So what more needs to be done on the reform front?
I think it's very important to look at the reform in three parts. One is obviously the tariff part, which we have talked enough. Second is that reforms on the maintaining supply of coal to the IPPs who have got plants ready. Linkages to be given on priority basis to them. That's number two. And number three is the reforms on the financial sector to help infrastructure and power companies to get their financing proper in place at the right capital cost. And we would recommend the following. You see, the first one that we think is that the depth of the bond market in this country virtually is non-existent. Number two, for the overseas capital, in the debt market in particular, we would recommend that the capital LCs for infrastructure and power sector, the tenure in any case should be extended from 3 years to 5 years, which in other words will tantamount to extra capital inflow, debt capital inflow in the country in foreign currency.
So are you expecting any of these measures to be announced in the budget?
Unfortunately, I am not in the finance ministry, so I cannot comment on that, but I'm sure there are very, very capable people in the finance ministry and Reserve Bank of India, and I'm sure they will look at this very closely because they know what they are doing.
Well, thank you very much for those insights, Prabal.
You are most welcome.
We are talking about the investment opportunities in the troubled Indian power sector and whether private equity investors like to invest in the sector or not. Joining me with their views on the matter is Karthikeyan Ranganathan, partner at Barings Private Equity. Karthikeyan, let me begin by asking you, when you invest in a sector from a private equity perspective, what kind of returns do you like to see? And are those returns of 20% possible from this sector?
I think they're no different from private equity returns, Punita. Meaning, I think on a dollar basis, upwards of 20% plus is what all private equity investors expect. And I would think that there is no different in an infrastructure asset.
Now, there's talk about corruption in the sector. Have you avoided any such situations where there's been corruption?
I think there are a number of companies where that falls off, right? Meaning, I think there's like the preliminary first cut evaluation, meaning a lot of, companies fall off simply because we don't think that the governance credentials would actually, stand up to scrutiny and to the level that we would want it to be.
Now, turning to fuel linkages, with the recent coal scam, do you see fuel linkages becoming more difficult in the future?
If a developer has to import coal to supply power, clearly the economics then is very different because, imported coal is a different price from domestic coal. Unless you allow the developer then to actually earn reasonable rates of return or higher power prices to actually earn those reasonable rates of return, nobody is actually going to put money into these sectors. You're right, the coal scams, the fact that Coal India has not been able to, perhaps increase capacity at its end is going to deter the availability of, domestic coal in this, in the country, and as a result, capacity which is based purely on domestic coal. But new capacity which can base itself on imported coal is also not being put up simply because, you don't have economic rates of return based on, global prices of coal. So unless we have free pricing, an integrated, planning mechanism for power projects, and the two going hand in hand, you're not really going to see too much, investments coming back into the sector.
Now, talking about the SEBs, what kind of tariff increases do you think are required for the developers as well as the customers?
So tariff increases, I think, should be market determined at the generation company end, and at the distribution end, it is but important for the SEBs to start passing on price increases, to end consumers. It is not possible to have energy prices so different from what is the market determined price.
Would it be fair to revise the PPAs, especially for developers who bid appropriately to begin with?
A developer has actually put up the project and he hasn't been able to earn an economic rate of return, and they are not operating this power plant and would rather, let go of the power plant. Why don't we actually put the whole asset into a new bid where there is a new developer who comes and takes it over, and then we would be able to find what is the new, the price at which we would be able to, actually earn economic rates of return.
But I don't think any of the developers want to let go of these projects. They rather have the PPAs revised.
It's a fair point, Punita. That's what the old developers want to do, but you can't. I think both don't work together. I mean, I think you have to take a call one way or the other. And I think as a government, I think one has to have a policy which is consistent. It will be lovely if the old developers do make those returns, but if that's not really possible and that's not fair from the principles of equity, which a government should try to apply to the entire, the developer network at large, one should actually employ this, process to ensure that the power sector is revived.
Turning to specific opportunities that you see in the power sector, in this space, would you rather invest in developers, T&D, or equipment?
If one were to look at, and one has to invest in the sector between T&D, generation, equipment, I would imagine equipment and generation is where we would actually put our money in. But that is also where after some amount of clarity comes through. On the equipment side, we actually do think that those companies which are levered enough to the public sector capex will actually do well, and the captive power equipment space will actually do very well.
So you are looking at equipment companies?
Yeah, we are looking at a number of companies across the sector, Punita, including equipment companies.
And what attracts you to the equipment companies?
Let me put it this way. There are a number of players who have actually reached a good scale and developed serious competitive advantages and differentiators. We do believe that those companies, if one believes in the long-term growth that we are likely to see in the sector, would be able to actually capture that growth as well as actually deliver good, decent returns on capital.
Thank you for your time, Karthikeyan. I'm joined by Anup Bagchi of ICICI Securities. Anup, let me begin by asking you, in terms of the measures that have been announced, which ones are going to help the listed companies the most? Is it the coal price pooling, the SEB restructuring, the tariff increases, or what?
Price hike will be number one. Number two will be SEBs. Number three, if the pooling and coal linkage becomes better, that clearly will be number three. But that, of course, is on things that have not come onto generation. But we have to also take care of people who are already generating.
Well, obviously, the high mortality rates are already factored into the valuations of some of these companies. So what is your view of the valuations in the sector?
As and when the interest rate starts to come down, you will start to see the enterprise value going up. But enterprise value going up, as you know, is meaningless unless the real variables start to move up. I think the first shot came by SEB restructuring and through price increases in SEBs. I think that was the first shot. I think the next shot will start to come, as the coal pooling and coal linkages get sorted out. Once that happens, I think then real viability will start to come for some of the stocks. And then, of course, if unviable PPAs start to come out, I can certainly see some of the stocks at least, moving up substantially, and it will give a great outperformance. It may double actually some of the stocks.
So would you invest in the safer companies like NTPC, or would you invest in the leveraged companies that are facing a lot of the problems today?
From an equity investor's perspective, they still remain, relatively high-risk companies. And to that extent, I will still go with NTPC, because they will be largely defensives, and, they will not create too much of volatility on your overall portfolio. However, if you want to play the beta game, but some of these have also run up. We must take that also into account. But I would still say that stay away from power sector for some time. And once I think the coal pooling issues get really sorted out, I think that is the time when one should really enter into these stocks.
Again, we've talked a little bit about the rally that has taken place. So would you advise investors to take a long-term view or trade in the sector?
No, at this point of time, I would say just trade in the sector.
Now let's talk about the different segments of the power sector. Would you recommend investors to invest in the developers, the transmission companies, or the finance companies?
If you are taking an overall view on the sector, I would say you can play the sector partly through the finance companies, PFC, REC, but more importantly, if you want to play the full infrastructure play, I have always maintained that it is best to play it through IDFC. And we have been sort of, making the case of IDFC because they are a good reflector, good portfolio of overall infrastructure story. Plus, they do their own risk management. So, as an investor, you don't have to do, case-by-case risk management. So, they are doing it as a portfolio. So, that's also a very good proxy.
You haven't talked about the transmission companies like Power Grid that benefit from increased capex in the sector? What's your view?
They are defensive sectors, Punita, because power grid, for example, it has been stable for quite a while, and they will remain stable. So if you were to make a portfolio of the power sector, I would say pick some stocks from the finance, because you start to get the basic benefits immediately, because their exposure is more and more towards the currently generating companies. Power grid, etc., they are defensive sectors. They are not very aggressive sectors. They are not very high beta sectors. So you can put some portfolios there. And then, of course, on the generating side, today pick up sectors which are already generating. And then you can play a little bit on the beta on which are not generating currently, but who have higher probabilities of these variables getting sorted out on a positive basis.
So what kind of returns do you think investors should hope to get in this sector over the next 2 to 3 years?
No, I think, again, if we were to break it up, let's say if you look at finance companies, I think they will by and large, there will be high beta, it will go with the finance sector. But if you look at power grid, I think it will be muted but less stable. So you can look at, 12 to 15% kind of return. On a generating company, if you can pick up stocks well, I think there is money to be made, but there is, as a portfolio, you may not make that much money, but because on a risk-adjusted basis, I think it will be as good or as bad as power grid. But individual stocks may run up quite sharply. It can really outperform.
Basically, you're saying that one should be underweight in the sector and invest in the safer companies for now, and only trade in the risky companies, correct?
That's right, that's right. Or just put an index and allocate a part of the index, and can keep it.
Well, that's very helpful. Thank you for your views, Anu.
Thank you, Punita.
Now let's talk to Tanveer Gill about what the rest of the market thinks about the power sector. Tanveer, what is the data showing on the power sector stocks?
Well, Punita, it's like a wide gamut, right? If we just take a look first at what brokerages are saying, PFC and REC have the most high conviction buys coming in from brokerages, as does NTPC. In terms of their returns, the stocks, the financiers have done really well in 2012. PFC, REC with the standout outperformers. Valuations, the best way to look at these companies is price to book, where the range is anywhere between 1 to 2 to 2.5, with the private players having a higher price to book from a 1 year forward perspective, and financiers as well as some of the ancillary businesses having a price to book of anywhere between 1 to 1.5 times. What is interesting is to see how their ROE pans out, because while a company like Power Grid has very stable ROE expectations of 16% plus, there's a lot of uncertainty about their profitability going forward. So ROE would not be really a clear indication of how the stock price would perform. That is a quick summary of how some of these power companies have fared from a stock market perspective. And Punita, coming to you now, you've heard a 360-degree perspective on where the sector is headed. How do you see the potential?
So clearly, Tanvi, there are a lot of challenges in the sector, and many projects are unviable. And it's also clear that the current reform initiatives are just not sufficient. Either the PPAs are going to be revised or they're going to be rebid, and that's going to be actually very challenging. So I think the government has no choice but to reform even more aggressively. Now, while a lot of this negative is priced in the market, I think that you still need to take a very long-term view on the sector, because these measures are going to take a long term to implement, and so you have to be a very patient long-term investor. In the short term, of course, I think there is significant trading opportunities, because we're going to see series of hopefully more announcements, and that will affect the stocks. So I think there's a lot of trading opportunities in those kind of companies if investors so want to take that risk. Well, that's my view. And with that, we come to the end of this episode of Hot Sectors with Punita Kumar Sinha. Thank you so much for watching.